Welcome to Market Experience Academy. Welcome to section or episode 8 of our beginners class. We are actually coming to the very end of the beginners class. When we are done with the beginners class, we actually do what? Graduate or migrate into what? The intermediate what? Class, where we begin to do what? Break everything that we have talked about in the beginners class into what details. We have to what expatiate more on every topics and everything that we have talked about on the introductory class. Intermediate is where we'll break everything down into what bit by bit. So please, if you have actually started viewing my channel from the beginning, please don't hesitate to continue watching it when we get towards the intermediate class of it. So welcome back this morning to another beginners section of our episode 8. I could remember that the last time we talked about in our last class, we talked about what trending markets and types of trends that we have in the Forex market. We talked about consolidation, and also we talked about pullback or retracement. So I think we'll move further today to actually talk about what we have today. Without further ado, just follow me as I share my screen. Thank you. All right, I believe that you all can see my screen. Right, so let's move to the business of today. So what we have before us is what we call support and resistance. Support and resistance. Support and resistance. From what we have in my slide, support and resistance is a concept that the movement of the price of a security will tend to stop and reverse at a certain predetermined price levels. Let me take it again. Support and resistance is a concept that the movement of the price of a security will tend to stop and reverse at a certain predetermined price levels. These levels are denoted by multiple touches of price without a breakthrough of that particular level. So when we're talking about support and resistance in the Forex market, we are actually talking about the ceiling and the floor. That's like the best illustration I could use to drive it home. We are talking about the ceiling and the floor. The ceiling simply represents the resistance, where the market has actually visited or did multiple touch in the past time that price visited that level. So price has actually gone to that level, visited it the first time, the second time, and the fourth time. In such a scenario, we will say that particular resistance is a strong resistance zone, because the market has actually visited that price in the past more than 2 or 3 times. The same thing is also applicable for the support. The support is known as the floor. When we hear the word support, it means something that is helping something to be firm, to balance very well. So that's what we call the support as the floor. That's where our foot rests. That's where our body marks rest. That's where the body marks of every object that obeys the law of gravity rest. So that's it. So support is also known as what? That point where price actually what gets to, that bottom price where the price gets to and it what move upward again. That's support. Where particular price has gotten to in the past future and is about to do what? Touch that particular level again before what? Bouncing back. That's what support. So in the forex market, support and resistance is a very big terminology, but it's one of the key strategy, one of the number one key strategy, one of the most simplest strategy you can ever use in the forex market or in the financial markets as a whole. So furthermore, the concept of support and resistance forms the basis of forex technical analysis. Actually, that is what it is. It actually was the key basis of what the forex technical analysis. Forex traders look to buy at or near areas of significant level of potential support. Yes, we tend to buy from the bottom, from the discounted price of the bottom, in anticipation that when the price of the market goes up, we make profit. We make profit. Then if we are buying from the top, we are what? Anticipating that we are buying from a discounted, we are selling from a discounted price. And when the market start reversing from the top side and start going down, we will do what? We will make more money. So instead of forex traders look to buy at what or near areas of significant levels of potential support in an uptrend and also sell or near areas of what significant levels of potential resistance in a downtrend. Yes, when we buy from the bottom, the market start doing what? Moving to the upside, making higher high, higher low, higher high. When the market makes such a move, it actually helps us to do what? Enter from the bottom, from the support, and we buy the market from a discounted price. And as the market continually to do what? Move upward, we make profit. The same thing is applicable to the downtrend. When the market is making lower low, lower high, lower low, lower high, we buy or we sell from what? The peak. From the top, we sell from the peak in anticipation that when the market continue to move downward, we do what? We make profit. So I will go and share my screen to just like to illustrate it on the chart so that it will not look so abstract. Okay, so this my chart. Just forget about the DXY you are saying. I just want to make an illustration of what I'm saying. All right, so let's say we have the price of the market making what? A higher high, a higher low, a higher high, and what? A higher low. And these words. Just follow me. You can see the market is doing what? Higher high, higher low. This is formally where this market is. We call this level our support. Yes, this was our support level. This is the floor, and this was the ceiling. So it is anticipated that as price has touched here the first time and second time, this was a strong support zone. A strong support zone. So when the price came here, touched the ceiling, touched the floor again for the second time, what you do as a trader, you do what? You buy from here. When you buy from this place, You put your stop loss here in anticipation that when the market price goes up, you make profit. Yes, you make profit. So this is what our floor and this is what our ceiling. So it is anticipated for every trader to do what? To buy from the support and do what? Sell from the resistance. You buy from what? The support and sell at the resistance. So as you can see, the market was going higher high, higher low. This former resistance was broken, turning towards support. This is a very simple market structure in Forex market or Forex technical analysis, but that's not what actually we're talking about today. Market structure is totally different from what support and resistance, but they're of the same family. Of the same family. So this is what our ceiling that was now price broke the previous resistance and what went up and what retested it as what as support. So this here now is no longer what resistance anymore since price took off this resistance and what retested. Now is the price is sitting on top of this former resistance as what support. So if you are to do what, enter here to do what, you buy in anticipation that the market will start doing what, going up, just like here. In anticipation that the market will do what, start going up. So you buy from here and put your what, your take profit here and put your stop loss around here, so that if the market price shoots down again, it will take you off with a small loss. So that's why we actually put like 10 pips here stop loss and we target 50 pips. That's how our risk to reward ratio increases. So if you're losing $10 here, you're anticipating to make what? $50 as the market gets to this point. So this is one of the simplest strategies you can ever use in the Forex market. Very simple and very okay. The market doesn't need complicated strategy. This simple strategy you are seeing, if well maintained, will make you one of the best traders in the world. I'm telling you the truth. You don't need to complicate your strategy or make your charts look like a nest. It's not necessary. That will not make you money. It's not how difficult or complex your strategy is that will make you money. It's even better to do it to keep it simple. Yeah, you keep it simple. So that's that for what? Support and resistance. So support simply means what? The floor, where the market price has touched more than 2 or 3 times in the future. That's our support. Then the resistance is the ceiling, where the market has touched more than multiple times. So like this, like we're saying here, now this is what? A resistance. This is a resistance. So in anticipation, you can do what? Put your what? Your sell from here in anticipation that yes, since the market price has gotten to here, there's a tendency that the market will start what? The price will start what? Going down to visit this support again, the support zone. So that's what support and resistance is all about. I hope this is well understood. So let's go back to our slide. So that's that for what? Support and resistance. So Forex traders look to buy at all near areas of what? Significant level of potential support in an uptrend, and also sell at or near areas of significant levels of potential resistance in a what? A downtrend. So there is that. Okay, so this is a diagram of trend, range, and pullbacks. Based on the classes, the previous classes we had, this is a diagram showing all the explanations we've made in the past about what? Trends. We told you that we have different types of trends. We have what? The uptrend, the sideways trend, or the consolidation or ranging trend. You're still saying the same thing. Then we have what? The downtrend. These 3 kind of trend is being found in any financial instrument in the world. They must make this move. The market does not just move to the up. If not, everybody could have been a billionaire. Yes, the market must at any point in time exhibit any of these moves or cycles. Exactly. The market does not just move in a straight fire. There's a trend time that the market will be trending. There's a time that the market will be ranging. There's a time that the market will be what? Going down. So these 3 cycles are paramount in any market in the world, in any financial instrument. You must, whether oil, whether commodity, they experience these 3 price cycles or market cycles. So when the market is making what? A higher high, a higher low, a higher high, a higher low, a higher high, we say that that market is what? An uptrend. And when the market is not making any high, just making a low, a high, a low, a high, without making a higher high, we say that that market is what? Is consolidating or is in a ranging state, a state of rest. But when the market makes what? Lower low, lower low, lower high, lower low, lower high, lower low, we say that that market was a downtrend. It's a downtrending market. So these are the three cycles that are found in every market in the world. Every financial market of security exhibits these three cycles. So put it at the back of your mind so that you will know your potentials when you see these cycles of the market playing out. As a short-term trader, you can still make opportunity or sell from these small little pullbacks you are seeing. This is known as pullback. This is a pullback or retracement. When the market makes a high, a higher high, a higher low, the higher low is expected to be what? A pullback. A pullback before it does what? Continue to the previous trend. There's a time that it will pull back 50% to do what? To rest. That is when traders are what? Taking their profits. There's going to be what? A pullback in the price of the market. Let's say that the market started from 0 and went to 10. There's a tendency that it will drop back to 5. That's 50%. Before what? Moving back to 15. Then drop back to 10, move to 20, and so on and so forth. So that's what the market does. It pulls back. So this is what we call retracement or pullback. Retracement or pullback. Retracement or pullback. This is also what? Retracement or pullback. Retracement or pullback. Yes. So let's say the market was around what? 50. It pulled down to what? It went down to what? 30 and still went up to 30 and went up to what? To 45 before what? Diving down to what? 10 or 20 and 10 or 5 again. So that's what in a downtrend, that's how we experience pullbacks. So these are what? Pullback in a downtrend, pullback in downtrend. Why this what? Pullback in uptrend, pullback or retracement in what? Uptrend. So that's that for what? Pullback and the types of trend we have. So this diagram is actually showing us what the cycles we have in the market. There's a point in time where the market will be on a state of rest. When it has made an uptrend or a downtrend for a long period of time, it will do what? Come to the point of rest where it does not make any significant move, but what? Continue to what? Gather more momentum. So when it gathers this momentum for some period of time or liquidity, then there's going to be what? A breakout or a continuation of what? The former previous uptrend or a reversal. Or what? A reversal. So I think that's that for what? The trending market. Let's go to the next topic we have. So we entered a new topic, types of analysis. Types of analysis. There are 4 main types of analysis in the market. We have the fundamental analysis, we have the technical analysis, we have the sentimental analysis, and we have what? The breaking news. These are the 3 types of analysis we have in the Forex market. And some traders are known based on what? These 2 types of analysis. Some traders trade fundamental analysis, which has to do with news, high or low impact news. Fundamental has to do with what? Economic state of a country or economic state of the currency pair of the country you are trading. Yes, if there are vital news or impacts or market news, political news that are actually influencing a particular currency, it will do what? Rub off on the currency pair that you are trading. Let's say, let's assume we take the US dollar, the non-farm payroll that determines what? The the level of employment in the United States. Whenever that particular news comes out every month, any pair that is attached with US dollar will experience a significant move whenever that price or news comes out. So that's what fundamental analysis. But when we get to the intermediate, we will do a little bit breakdown on it. We'll do a little bit breakdown on it. But fundamental analysis has to do with news, economic or political news. Economic or political news of any country currency has a way to do or to rub off on the currency price. Now, when we're talking about technical analysis, we're talking about the analysis that has to do with data presentation. We use data presentation of a particular currency pair to actually forecast where the market price or what the possibility of the market price in the future. That is what technical analysis. It has to do with price actions, support and resistance, patterns. These are what known as what technical analysis. Sentimental analysis has to do with the pressure of the buyers and the sellers. The pressure between the buyer, the competition, the competitiveness of the buyers and the seller brings about what market sentiment. So sentimental analysis has to do with the magnitude of the buyers towards the sellers. When there are like 1,000 persons buying Euro USD, and there are like 100 persons selling Euro USD, which people will make high impact in the market? Definitely the people, 1,000 traders that are buying what the Euro USD are what we tend to do to move the market price upward. So that is what sentimental analysis is all about. Why breaking news is what, just like the name implies, the news that is happening at the moment. The news that is happening at the moment. Let's say there's an earthquake or bush burning in Australia or earthquake in Oklahoma. That news will immediately affect the economy or partly the economy of what the United States or Australia. So that's what breaking news does. The prevailing news, the news that is happening immediately. So that's what these 4 types of analysis are all about. So I'm not really going to go that deep trying to break them one after the other, but I think we will look into them extensively in our intermediate class. So let's proceed to the next class, the next slide. Types of traders. Types of traders. There are 4 main types of forex traders in the market. We have the scalpers, we have the day trader, we have the swing traders, and we have the position traders. The scalpers are the traders that actually don't stay very long in the market. They don't stay long. The highest they can stay is nothing less than 5 to 10 minutes in the market. And they majorly carry out their analysis in let's say 15 minutes chart or 1 hour chart, just to do check the trend direction in a short term, the short term trend direction. So they actually use an hour chart or even 15 minutes chart to check out the short term trend direction, and they use the 5 minutes or 1 minute chart to do to execute their entry. These are scalpers. They don't stay long. They stay highest 5 minutes or 10 minutes in the market, and they do away with the profits or loss. But the day traders, as their name implies, are traders that stays their trades are running for a whole day. A whole day. These are traders that take their trend direction from the 4 hours or daily. They use the 4 hours chart and the daily chart to carry out the analysis, to know currently what the market is doing, the current direction or trending market of the possibility where the market is moving on a long run. So they carry out or they project the market direction using the 4 hours or the daily charts. and maybe execute their entry in 1 hour, 30 minutes, or 15 minutes. These are known as what? These are known as day traders. Swing traders are the traders. Swing traders are the traders that are in the market for 2-3 days or to 1 week or 2 weeks. Their orders are open in the market for 2-3 days or even 1 week. These are traders that take their market or trend direction from the weekly chart to the daily chart and execute their entry in 4 hours and probably 1 hour. These are known as what? Swing traders. They can stay, their position can be open for a couple of days and even weeks. While position traders are known as long-time traders. Long-time traders. These are traders. They are known also as what? Investors in the market. These are traders that allow their order to be in the space of 3 months, 1 year. They can be in a particular trade for a level of 3 months, 6 months, even a couple of years. So these are known as what? Trend followers. They follow the trend. They trade long term. They can carry their projections in monthly charts, and maybe enter via what? Daily and what? 4 hours. They execute their trades in what? Daily or 4 hours. So they carry out or monitor their trend directions through the higher time frames like the monthly charts, the weekly charts. That's where they carry out what? Their major analysis and project a long-time investment that could take 6 months or 1 year. So they are not the regular scalpers, day traders, or swing traders that are in and out of the market. These guys can enter the market and leave it to run for a period of 6 months, a period of 3 months, a period of 1 year. So these are known as what? Position traders. So I believe this class is well understood. I will not really want to spend so much time. So the next episode now, we'll be talking about what? Risk management. Introduction to what? Risk management. Risk management in the forex market is what? The backbone, or what will determine what? Your longevity in the market. Risk management is what? Everything in the market. A trader that does not have risk management attached to his trading plan will continually to do what? Move in circles. So thank you so very much for this morning section, episode 8 of our class. So the next episode 9, we'll be talking about introduction to what? Risk management. So thank you, and what? Have a blossom day ahead of you.